Nothing in this program should be considered investment advice. It is for educational purposes only. Please hit pause and read this disclaimer in full. Hey, hello everyone. This is a very special Finance University that's about to be recorded here. I'm sitting here with Paul Kiker. Hey, Paul, in person. I always love in person.
This is so good.
Weird circumstances. We're in Atlanta. We're at a conference. And of course, today I'm looking at the market. The Dow is down 2,200 and some odd points here. So we just thought, well, we're going to have to talk about this. And this is on top of yesterday's losses. What does this mean? I think this is a 2008 style liquidity crisis. We're going to go over the data for that, talk this through, because this is a really big event. If it is a 2008 style liquidity crisis, you're gonna have to be prepared for this, because prices get set by people who have to sell for whatever reason. And so, listen, everything gets tossed out, baby, bathwater, the whole 9 yards. So,
Yes.
Paul, you're in the biz. Or you, yeah, well, I mean, you've been here long. What do you think of today? I mean, am I overselling it here?
No, I don't think so. This was a pretty massive move across the board. I mean, just from top to bottom in a matter of 60 days. Yeah, I've seen the Dow go down 15%, S&P's down 17%, NASDAQ.
In how many days?
In, let's say, 60 days.
Yep.
But the top was, we talked about 2 months ago, February. So NASDAQ's down 21% in 60 days. And the magnitude of this move is really fast. You know, instead of getting a sell-off with a little bit of support and, you know, bounce and rally, especially what we've been trained over the past, since the 2008 crisis, is you're going to at least get a counter trend rally, even if the trend is changing. But this was shocking. And of course, the tariffs are the excuse that the market started selling off for.
Mm-hmm. And well, that's what it says right here. Trump tariffs spark worst weekly meltdown here on Yahoo Finance. You buying it?
No.
No. Me neither.
I mean, this market was primed, overpriced. So the question is what's going to fuel this market if the Fed's standing back? Because the Fed came out today and said the tariffs are inflationary, so they're on hold. And I was actually expecting that Saturday, Sunday, especially over the past 15 years, anytime there was trouble, we got QE, Operation Twist, QE1, QE2, interest rate cuts. And
so Powell came out today and said, no rate cuts.
Yeah.
That's the Fed just standing aside and letting this bus go right on by, huh?
Yes.
Yeah, well, that's new. So a lot of people were expecting a bounce because of the Fed was going to step in, because the Fed's always been there. And you and I have talked about this over the months, saying, what if the Fed doesn't come to the rescue? Mm-hmm. You got a lot of traders, they're young bucks, they haven't experienced anything like this. They just know the Fed's going to rescue this thing.
Yes.
The Fed just stepped aside today during arguably one of the worst down days. I think, well, you have some data there, right?
Yeah, so we got some data. So
I mean, this is a historic day.
So yesterday, data, because I learned this, I looked at this recently and I have so much going through my head, I want to make sure I had it right. So Goldman reported today, by total shares traded across all exchanges in the U.S., the highest volume in history. And I don't have the chart to show right now, but it blows every historical record out. You know, one thing you pay attention to is there's conviction when it's on volume. So the fact that we have big volume means that this is convicted selling, or someone's deleveraging, and, you know, and we hear somebody goes down over the weekend.
Yeah. Well, let me see if I can get, do they have, nah, just 1 week. Well, let's do the 1 week performance, because that sort of tells the tale here a little bit. So we got NVIDIA down 14% on the week. We got Apple down 13.5%, Amazon down 11.2%, Google, Meta, 5 and 12%. But this is what I'm focused on for the moment too, because this is the liquidity crisis idea. Paul, let's look financial services here. Banks, JP Morgan down 13.4%, Bank of America 16.6%, Wells Fargo, everybody's down. This is pretty big. Well, not Berkshire, because of course he's sitting on $300 billion in cash. He's that dummy.
Cash. Smart move, you know. And when everybody's saying, "Put your cash to work, put your cash to work," call your brokers. I actually had a conversation with somebody today, and we got talking about the market, and they were like, "Hey, my broker called today and said, if you got some money, let's put the cash to work." He slapped. He said, "You've already convinced me to put all the cash to work. I don't have any left. I'm fully invested."
Right.
So how do you buy the dip if you don't have any cash?
Well, yeah, of course. So this is where the risk managed portfolio is stupid important at this. But just today's damage alone, looking at the one-day returns here, healthcare. I mean, listen, only things I have green on here are the home builders and Nike, because I think Vietnam folded on the tariffs. So maybe that's a tariff story, right? But this is just stocks. We're talking stock universe here. I want to go to commodities in a bit because we have to read the totality of the picture here. Everything was getting sold, and the weird thing to me, Paul, was normally, if this is a normal downturn, you get the jello go from equities over to bonds.
Yes.
Slides across the plate.
Yes.
Bonds didn't really rally all that hard, as far as I'm concerned.
No, they didn't. We closed today, this is Friday, at 4.01% on the 10-year. So we didn't even break 4%. And that's a minimal move considering the magnitude of the market sell-off. So at best, that tells us that there's confusion on where to go.
I think it was only like 405 this morning, so it really didn't even budge, like a few basis points. It wasn't much.
Yeah, well, my chart's not showing end of the day yesterday. So unfortunately, I can't see that. But yeah, but it didn't move very much at all.
Meaning, this isn't just a jello moving across the plate. This isn't just sort of, there's no sector rotation happening here in the stocks, and there's no asset allocation rotation going across stocks to bonds.
No, this is liquidity.
Liquidity selling. All right, look, can we talk? So 2008 was a liquidity crisis.
Absolutely.
All right, what does that mean? Because a lot of people don't know what that means. Like, we're not talking about water.
No. So liquidity crisis means that the problem is if you're fully invested at all times and you wait, you either get forced out, you're driven out, or you puke out. Your emotions kick you out of the market.
Yep.
So going back to that data, after Lehman Brothers collapsed, that triggered margin calls across the board. There was a period of time back then where Hank Paulson, I believe it was, had to step in. They had, money market accounts nearly fluctuated. Money market accounts traded $1, so they call it nearly breaking the buck. So if money market accounts are not supposed to do that, they haven't historically. They claimed that the money market accounts were going to freeze shorter term liquidity, and they had to have this intervention. During that liquidity crunch right there, crisis, there were no buyers. Everybody was having to pay off their debts. The individuals, the banks were upside down, and they're having to call all these loans in. And the S&P during that following month, October the 6th to the 10th, in 4 days dropped to 18%. So 18% in 4 days. And then you had gold got crushed. Bonds went down dramatically in the short run period of time. That was one thing that I was surprised about back then, was normally you would look to bonds, and those people who went into bonds were down, I can't remember the numbers without going back and look, but I think AGG was down 20-25% during that period. Don't hold me to that because I'm going off of memory, but it was down a lot dramatically during that period of time.
Yeah. So when I think of a liquidity crisis too, I think about, so you and I, we operate typically with a leverage of 1. I have $100, I buy $100 of stock. Now, I might not like that it goes down, but that's it, right?
Right.
When I think of leverage, Paul, I'm thinking of hedge funds and all the Wall Street players, and they don't like 4% returns or 5. No. They want 40% returns, so you get that with 10-to-1 leverage, meaning, let's say you raised $100 million from friends and family. They're like, I can't lose 20 years. This strategy has always worked. I back tested it. You do that, it looks good. Yeah. And then you go to your Goldman Sachs people and you're like, look, I got $100 million in play, but I'd like to do better. And so they'll loan you a multiple of that.
Yes, they will.
Let's say 7x. They'll give you $700 million. Now you have $800 million to work with. And you put all that to play in your can't lose strategy. Never fails, right? The Fed always bails us out. Whatever your thing is, all of a sudden you live through that first, things are selling off after February. It's painful. You're getting calls from friends and family like, how are we doing? And you're like, oh, it's good. But if you're down 100 million on your 700, 800 million, you just lost all your capital.
Yes.
You can only take a 14% loss in this story. Okay, so there's all these players, and they're watching it hemorrhage, and then yesterday was a big puke.
Yes, it was.
And then today was the big puke. These are people, all of a sudden, it's not even your friends and family saying, Paul, what's happening to my money? It's Goldman Sachs saying, we're going to have to unwind that loan we gave you.
Yes, and they do it, they'll take over and unwind it for them. This isn't by choice, it's forced in most cases like that.
So there's like, what's in your portfolio? We're selling it right now. And it doesn't matter if it's something that's great or a dog, it doesn't matter. Gold, if you have it in there, it gets sold. If you have silver in there, it gets sold. If you have oil, it gets sold. If you have stocks in there, it gets sold. Everything gets sold.
Speaking of that, silver was crushed over the past couple of days.
Oh boy, yeah, how about that?
I don't know where the bottom is, but I do like silver from a long-term standpoint. And copper had the biggest weekly drop since the COVID crash.
Biggest weekly.
Biggest weekly drop since COVID crashed this week.
Okay, so oil also smoked.
Yes.
Really smoked at this point in time. So copper and oil, is that saying recession?
I would think so.
Or is it just everything's getting sold?
It's hard to tell right now. I mean, so the question that I have is this, so the speed of these market moves is getting faster and faster and faster.
Yeah.
Computers, algorithms, computer trading programs. What are statistics? Can you remember the number of traders that are actually computer programs? Humans just aren't there anymore.
Well, I remember it was 2014 or 15 across the 50% mark, and now I think it's like 95% of all trades are computers, just algorithms. Just it's a program. If VIX goes down, I do this, and then that, and then this. It's just all sort of a programmatic. Well, it's just a logic trade. This, then that.
Yes. So the question is, Trump comes out. Goldman stated when the tariff news came out that it was worse than their worst case scenario. So there's going to be some normal rebalancing in there. Oh, the other statistic, pensions rebalanced had the largest end of quarter buy in their rebalance that we've had in history, if I remember the statistics correct.
Well, they just had a lot of cash kicking around.
Yeah, well, so market sells off in February and is down. Bonds held up relatively well, so they have to rebalance back to their basis. So they were selling some of those bonds right back in the stocks, literally just in time for this major weekly decline here. So that's going to put more stress on the pensions.
Of course. Oh, they're terrible.
Right? So the question is this just a fast reaction to the tariffs? But I'm not buying the tariff argument. But
Okay, well then what does make sense? What fits? I mean, yeah, we knew those markets were stretched. We've been talking about that. The most expensive in history is not a good starting point to have a. There's a lot of air under a market that's stretched out, but could this be more? Are you thinking, is it political?
Well, I don't know so much political as it's just the liquidity coming out of the system, the understanding that Trump's serious about supporting labor at the expense of capital. Because the prior administration did everything from a globalist standpoint, bring in all these immigrants. What was it? What's the news came out? 2.1 million Social Security numbers. Well,
that was shocking. But that was Social Security numbers given to illegals.
Illegal immigrants.
That's not how many illegals came in. That's just a subset. But yeah.
So outside of the voting, that's bringing cheap labor in to keep labor down for American citizens, and that's at the expense of labor for the benefit of capital.
Yeah, do you remember? I have at least 3 liberals saying, but who's going to do my yard work? You remember that? They're all concerned. Who's going to build our houses?
Yeah,
right?
who's going to build our house?
Americans. That's what's good.
Americans, and they'll do a good job, and there are a lot of people out there when the wages are sufficient for the level of work that goes into it. So I'm wondering if there's just a realization in these major firms that hey, he's serious about supporting labor, and he's courageous enough this go around. Because one thing that I've worried about, even on the tariff announcement, I hedged a little bit when you and I were talking, because I clearly remember in 2017, Trump was obsessed on the markets. It was everything markets. Every time they would start to go down, it was a tweet.
He was out there tweeting on it.
Yes. In this case, there was a few tweets today that and he mentioned that the Fed needs to cut rates. The Fed came out and said that they're not ready to do that yet. But he seems to be serious about getting the tariffs in place, leveling the playing field. And another reason I'm not don't necessarily agree that this is all tariffs. That's the excuse. But the formulas are out there. I mean, this is clear formulas for anybody to look at. He's explained clearly he's trying to equalize the playing field. Mm-hmm. So I think it's more than that. I think this is just a bull market that's running on fumes. And the realization is that, yes, we're probably going to have a recession. If we don't have a recession, at a minimum.
Oh, we were due one for a long time.
Due one, and we need one.
Yeah.
We need to get it now instead of later. And unfortunately, that's going to hurt the people that aren't prepared. But if they follow the advice we've been sharing with people, 12 to 24 months worth of emergency fund, harvest some of your profits, get yourself in a position to be prepared for it, just good, prudent, financial management of your household assets, then you're in a position to come through this, weather the storm better, or be in an opportunity to capitalize on the disruption that the recession is going to cause.
Right. Well, if we look at this obviously across the major world equity markets, right? So I'm just talking Western stuff, including Japan. So Europe, Japan, U.S., there's no winners in this story. So it feels kind of like, ever since October 2023, we saw mysteriously the stock market broke all sorts of support, and then that night it went the other way, and we've had 18 months of it just going up and to the right, and I think there's a lot of support that happened in there. Somebody reliquefied the markets, fine, they had a plan. But that was under Biden. So I asked about the political thing because who knows, maybe because it's Trump, maybe they're willing to just step aside.
It could be.
Could be some part of that. But if that's the moment where they started reliquefying, I think that's a reasonable target to say where this could go, and that's around 4,000 on the S&P.
It is 21% lower than where we are here. But the problem with that is that's a price-to-earnings ratio of 20 on the S&P at current earnings rates.
You mean getting all the way down to 4,000?
Yes.
Just gets us back to 20?
Gets us back to 20. So you have,
Well, that's like the expensive fare. Yeah, it's only relatively fair compared to where we've been.
Matt, you get back to a price-to-earnings ratio of 10 like we did after staying at a price-to-earnings ratio of 20, late
2,000?
late 60s. That's somewhere in the neighborhood of 2,000. Yeah, it's a 60% decline from top to bottom.
Yikes. Ouch.
So, and that's assuming the earnings hold up.
Yeah.
But I got to thinking about this today. So if you're the Fed, maybe it's political, maybe it's not. I mean, they've been the spotlight. Everybody understands, well, not everybody. People are starting to understand that the Fed is the source of this inflation issue. They've overheated the economies where the inflation comes from. So it seems to me like this might be the excuse to stand back and go, oh, it's the tariffs. It's their fault. Look at them, not me.
Well, there was some finger pointing today, right? Didn't Powell also said, oh, those tariffs are going to be very inflationary. He pins the tail on that donkey, right? It's like, no, that was you,
That's right.
Yeah.
So I am amazed by the home builders surging like they did today, though.
That doesn't make much sense to me.
Unless that's just sheer speculation that rates are going to go lower and we're going to continue to build like crazy.
Either that or this tale we're actually telling is that this is a tale of everybody being on the one side of the boat, and then they run to the other side of the boat. So maybe everybody was already on the short side of the home builder boat, and they had to run over to the long side of the boat.
That's a very good point.
When it's a liquidity crisis, Paul, my message here is that prices don't give you information except for who just had to sell a whole bunch of stuff, right? So if somebody happened to have been really short the home builders, they're going to have to buy them to get out of those positions, right? So this is why the liquidity crisis is such a weird moment, because you can analyze everything from a value or a price movement or momentum or a other standpoint, but when you get to a liquidity crisis, the only thing you need to know, and you and I can't know this from the cheap seats except to read the tea leaves, is to know that somebody had to sell a bunch of stuff, and I can point to it, but I don't know why, I don't know how leveraged they were, but I will guarantee you, based on these moves, somebody blew up.
Now, sure looks that way.
If we're lucky, it's just some smallish hedge funds and there's some capital erosion on Wall Street. If we're unlucky, it's a UBS, it's a PNB, it's a Deutsche Bank, not to pick on European firms, but they tend to get clocked more than
They do bad.
somehow.
Well, and
Make of that what you will.
the problem with that is that could further exacerbate the sell-off. Not necessarily saying that that's the case here, but that could further exacerbate the sell-off, especially if there's somebody that's a big derivatives player.
Right.
That's my biggest concern.
Mine too. And of course, we can't know that out here in the cheap seats. But you remember, I'm going to rewatch it because I rewatch it like every quarter. The Big Short is honestly one of the best movies ever done.
Watch that again.
Right? See, you do. Just for Margot Robbie to describe collateralized debt obligations to you from a bubble bath, right? Just for that scene. It's amazing. But the big thing in there was that these guys bet right, and Goldman Sachs wouldn't let the price move on the bonds, the insurance policies, derivatives that they bought. So the derivatives market itself is subject to shenanigans, right? And the thing is, I was having a conversation with somebody earlier. They're like, oh, but the great financial crisis, we learned our lessons. Like, no. Derivatives are bigger. Too big to fail is too bigger. Everything's just got supersized. Nothing got corrected.
No, it hasn't. All in. What's the rule? If you borrow money from the bank, borrow $1 billion. I can't remember the quote.
Yeah.
And then the bank's invested in your success. And one thing I want to share about today, and I thought this was pretty interesting. So I'm seasoned. I've been running risk managed portfolios for some time. That's where the gray hair and lang hair and all that stuff comes from. But even today, so we had a few positions. We'd already reduced a lot of exposure in the portfolios, but we had a few positions that broke support level at the end of the day yesterday.
Yeah.
So they have to break support on that day. That's a decision point. It's a line that you cross. I see the futures that are down this morning, and it's amazing the emotions and temptation. This is why discipline is so important, and you have to control your emotions. And, and normally I'll have that investor plan, not your emotions. So I had these thoughts come in, well, what if today's the bottom? You stop out of this. What if you wait until Monday? And we had the discussion. I stepped on the investment committee, and I said, yeah, but the reality is we crossed a decision point. We don't know what the future is. The strategy says that you sell these positions on this day. What's the worst case scenario? You look like a fool for a week or two. The damage has been done. If the Fed's not going to come to the rescue, we're headed to a recession.
Yep.
Then we may rally, but my expectation is the worst is still ahead of us unless something dramatically changes.
Well, I'm looking here. So I'd be interested to know what some of those positions are. But the most active shares today, we had NVIDIA clocking in at the top. Intel, surprisingly, looks like it was green on that. Ford, Lucid, and Tesla, all just really getting hammered here, most active. So, and it looks like when we had here, let me go back to my home. Let me pull in here. So NVIDIA ends up finishing out at 94.31, so breaks the 100 mark, right? It was just recently at, I think, 100 and closing in 140. Might have hit 140, but it was in the high 30s for a long time. It looks like the AI story's over, huh?
It sure does. It sure does. And you've got the individuals that are heading for the exit before. The real professionals are trying to get out. They've been selling, as you see, a lot of Microsoft, some of these other positions that have been topping. Even Apple has been looking like it's been in a topping process. And it's never different this time. Like, you can go back and look at the internet stocks.
Yeah.
Back in the late 1990s, and then you overlay that with the AI stocks, and people buy these themes. They're not making any more land, right?
Yeah.
2007.
Yep.
And they convince themselves that this is the answer. This is going to make things easier, and especially how inflation has squeezed households in every level, except for the extreme top couple of percent. This is the answer to make life a little bit easier for me, to make me a little bit more secure. And they get out of the mathematics and they get caught up in the psychology and the emotion and the euphoria. It's fun. Right? It's fun. But the problem is the hangover is pretty terrible.
Well, I'm surprised that Bitcoin, I mean, it got clocked like everything and it's down for sure, but watching that end of day rally there, finishing out over 81,000, I was a little surprised. I thought it was going to dip under 80 because it's been a risk-on asset for a long time, and today was a risk-off day.
They did.
So that's interesting. It would suggest that who's ever in on that is not connected and leveraged with all the rest of it.
Correct.
In some important way, I guess.
Well, and one thing that to take into consideration, and this is a concern from a long-term standpoint. If I remember correctly, we're in corporate buyback blackout because it's right before earnings. So, we've had record after record for the past several years of corporates entering the market and buying back their stock. So you get some negative news that triggers the market to sell off while they're gone, and there's no liquidity. So you're seeing multiple asset classes drop like that.
Yep.
What's going to happen if these corporates have to really reinvest into manufacturing in the U.S., pay higher labor rates, and that's gone from the market? My expectation was you would see multiples, price to earnings ratios, go back to historical norms, which wouldn't be continued to be overly expensive.
Yep.
It would be lower.
So, all right, let's pretend it's tariffs for a minute then, though. So the way I understand the story right now is, and this takes almost Kissingerian levels of like genius, and I'm not sure we're there yet, but if we take the at face value, somebody was able to do math like we are and said, oh, we're kind of in a long-term fundamentally bad position as the United States, right? We've been exporting dollars, did a good job, but we haven't, our manufacturing got hollowed out, our value add got hollowed out. So we can't just be forever a consuming nation who's got more and more debt. So sooner or later, you're going to have to pull a painful Band-Aid off of that story and get this, reshoring, right? So we're going to put manufacturing back in the U.S. Problem is that we have a very, very uncompetitive cost structure compared to the rest of the world.
That's correct.
So I don't know how you begin to square that circle, but if this is a part, we're going to use tariffs to at least level the playing field is step one. Step two, we make sure our energy is cheaper so we have a competitive advantage to offset the labor cost and also regulatory burden cost. Maybe we whittle at regulations as best we can over time. But that's like a multi-year, very ambitious, let's make America back into something it used to be, but hasn't been in a long time.
Yes, at least since the 70s. It was supercharged, 70s, early 80s. It was supercharged with globalization in the 1990s, which is great for capital. It's great for the large corporations.
It's bad for middle class.
It's bad for middle class. It's bad for small business. But, the process would be painful for those who are blindly and passively invested in the market and investing based off the rearview mirror instead of using the rearview mirror to learn from the mistakes of the past and then use that to be adaptive for the road signs that are ahead.
Yeah. Now, we're going to have to wrap up soon, but I guess, looking forward, what are you looking for Sunday night when futures open? It's a good question. And by the way, just to set this up, I've had people tell me, the market's oversold, look for a bounce. And I would remind them that every single crash has happened from oversold conditions.
Yes.
Not from, overbought conditions.
So I would think, and this is what I'm thinking about going into the weekend. So all day long, all I could think of is we executed, we followed our discipline on the few positions that we had to, and I didn't like it. But most of the things we really enjoy from a long-term standpoint, we don't like doing initially, but you keep doing what you know will lead to good outcomes. Discipline. And so I was kind of sitting there thinking, oh man, Fed's going to come out or Trump's going to do something on Sunday.
Yep.
Futures are going to be down. The market's going to surge dramatically higher. Well, then Chairman Powell comes out and basically says, we're doing nothing. And Trump seems to be holding the line. So I'm really curious to see what's going to happen over the weekend, what news is going to take place, because mom and pop are going to go home. We watch this for a living. They're going to look at their statements. They're going to see the news media, which is going to be just talking about how horrible the tariffs are, because the mainstream media, which most of them watching, most of them aren't on X or have the access to resources that we do, have learned to find the things that we do. And that fear is going to kick in. They're going to pick up and call the brokers on Monday morning and say, should I get out or do I want to get out? Because modern portfolio theory says be fully invested at all times. And we look at savings rates, they're low, people are invested. So I don't know what's going to happen on Monday. But if this builds going into the weekend and Chinese markets, European markets open lower before us, then I wouldn't be surprised to see some follow through on Monday.
Right. And just to be clear, you weren't fully invested coming into this, were you?
Oh no. we had minor position, but we had dramatically reduced exposure coming into this. We have a couple of portfolios that are a little bit slower to get out, but they're from a more aggressive investors, and even those have been reduced coming into the day. So we were very defensive and held up very good during the sell-off.
Excellent. All right. Well, I'll be talking to you Sunday night.
That's the cool thing is we'll get to see each other again Monday, so we can do a quick update.
Yeah, we might have fly rods that we might be on a river when we do this next. All right. Well, hey, thanks for being here, everybody. If you again, financial advice coming from Paul and his team, you go to peakfinancialinvesting.com, fill out a simple form. This is a time to be very defensive and have a risk-managed portfolio. Strongest advice I can give, such as it is. So thanks for listening. Be nimble, everybody. Paul, thanks for your time again. It's so good to see you. All right. Till next time.